Hey, what's up everybody? It's Daniel Smith here and welcome back to the channel. Now, if you've been keeping up with the markets lately, you know that cryptocurrency is absolutely on fire right now. But let's be real, it can be pretty volatile. That's why today we're diving into some pro tips for short-term gains in cryptocurrency trading. We're talking about strategies that could potentially make you some serious cash in a short amount of time. Of course, always remember that trading crypto comes with risks, and it's crucial to do your own research before investing a single dollar. Before we get started, make sure to hit that subscribe button and turn on notifications so you never miss an update. We've got some killer content coming your way and you don't want to miss out. Now let's get into it. Alright, let's kick things off with technical analysis, or TA for short. This is basically like having a crystal ball for the crypto market, and trust me, it's a game changer. See, technical analysis involves studying charts and indicators to predict future price movements. It's all about identifying patterns and trends that can give you an edge in the market. One of the most common tools used in technical analysis is the candlestick chart, which we'll dive into in a bit. These charts show you the open, high, low, and closing prices of a cryptocurrency over a specific period. By analyzing these charts, you can start to see patterns emerge, like support and resistance levels, which we'll also cover later. Now I know what you're thinking. Daniel, this sounds complicated, but honestly, it's not as daunting as it seems. There are tons of resources available online that can teach you the basics of technical analysis. And once you get the hang of it, it can seriously up your trading game. Just remember, technical analysis is not foolproof. It's just one piece of the puzzle. You should always consider other factors like market sentiment and news events before making any trading decisions. But trust me on this, guys, if you're serious about making short-term gains in crypto, you need to master technical analysis. It's the foundation of any successful trading strategy. So, take some time to learn the ropes and you'll be well on your way to spotting those profitable trades. Alright, so we talked about candlestick charts earlier, but let's really break down why they're so important. Imagine these candlesticks as little storytellers, each one whispering secrets about the price action of a cryptocurrency. They're like your own personal Wall Street journal, but instead of boring text, it's all visual. See, each candlestick represents a specific time frame, whether it's a minute, an hour, a day, or even a week. And each candlestick has a body and two wicks, which tell you everything you need to know about the price movement during that time frame. The body of the candlestick shows you the opening and closing prices. If the body is green, it means the price went up during that time frame. Bulls are in control. If it's red, well, you guessed it, the price went down, and the bears are running the show. Now those wicks, or shadows as some people call them, are important too. They show you the highest and lowest prices reached during that time frame. The longer the wick, the more volatile the price action was. By looking at the shape and color of these candlesticks, and how they line up with each other, you can start to identify patterns, like the famous head and shoulders or double bottom patterns, which can signal potential trend reversals. Learning to read candlestick charts is like learning a new language, the language of price. It takes time and practice, but once you get it, you'll be able to see opportunities that others might miss. Alright, now let's talk about support and resistance levels, which are basically the battle lines in the constant tug-of-war between buyers and sellers. These levels are like psychological barriers that traders watch closely, and understanding them can give you a huge advantage. So, what exactly are they? Support is like a floor, a price level where buying interest tends to be strong enough to prevent the price from falling any further. It's like a safety net for the price. On the other hand, resistance is like a ceiling, a price level where selling pressure is strong enough to prevent the price from rising any higher. Think of it this way. Imagine a stock you're watching. It keeps hitting $50, then bouncing back up. $50 is acting as support. People are buying when it dips that low, pushing the price back up. Conversely, if it keeps hitting $60 and dropping back down, $60 is resistance. People are selling at that price, pushing it back down. Identifying these levels is crucial because they can give you clues about where to enter and exit trades. For example, you might consider buying near a support level, where you expect buying pressure to push the price back up. Or you might consider selling near a resistance level, where you anticipate selling pressure to push the price back down. Of course, these levels aren't always exact, and sometimes they can be broken, but by understanding the concept of support and resistance, you'll have a much better grasp of how traders think and how price action tends to play out. Alright, we've covered charts, candlesticks, and support and resistance levels. Now let's talk about another crucial element of technical analysis, trading volume. Think of volume as the fuel that drives price movements. It tells you how much buying and selling activity is happening for a particular cryptocurrency. You see, without sufficient volume, a price move can be like a house of cards, flimsy and easily toppled. High volume, on the other hand, acts as confirmation, adding weight and legitimacy to a price trend. Here's an example. Imagine you're looking at a stock that suddenly shot up in price. Seems great, right? But then you notice the volume is super low. This could mean that the price spike was caused by just a few big players, and it might not be sustainable. It's like seeing a lone swimmer doing laps in a giant empty pool. A bit odd, right? Now imagine a different scenario. The price is steadily climbing, and the volume is increasing alongside it. This indicates strong buying interest, suggesting that the upward trend is likely to continue. It's like seeing a packed pool on a hot day. Lots of activity and energy, so always pay attention to trading volume. It can help you confirm the strength of price trends, identify potential breakouts or breakdowns, and avoid getting caught in false signals. Remember guys, trading is all about making informed decisions, and volume is a key piece of information that can help you do just that. Okay, we've talked about all these strategies for identifying potentially profitable trades. But now, let's talk about protecting yourself. Because let's be real, even the best traders in the world don't win every single trade. That's where stop-loss orders come in. They're like your emergency brake in the fast-paced world of crypto trading. Basically, a stop-loss order is an order that you place to automatically sell your cryptocurrency if the price drops to a certain level that you set. It's a way to limit your potential losses on a trade. Think of it like this. You buy a cryptocurrency at $100 hoping it will go up, but you also set a stop-loss order at $95. This means that if the price drops to $95, your order will automatically be filled, and you'll sell your cryptocurrency at that price, limiting your loss to just $5 per share. Now, I know some of you might be thinking, but Daniel, what if the price drops temporarily and then goes back up? I'll miss out on potential profits. And that's a valid concern. But remember, trading is all about managing risk, and sometimes it's better to take a small loss than to risk a much larger one. Plus, you can always adjust your stop-loss order as the trade progresses, or set it based on your own risk tolerance. Trust me on this guys, using stop-loss orders is crucial for protecting your hard-earned money in the volatile world of cryptocurrency trading. It's one of the simplest yet most effective risk management tools available to you. Thanks for watching. If you found these tips helpful, give this video a thumbs up and share it with your friends. Let's spread the knowledge and help each other succeed in the crypto market. Don't forget to leave a comment below with your own trading tips or any questions you have. I always love hearing from you guys and learning from your experiences. And as always, remember to do your own research before investing in any cryptocurrency. This is not financial advice. It's just me sharing my passion for trading. See you in the next video.